G'day expats and welcome to another episode of Expat Chat, episode number 59 today. And no, we're not joined by James Ridley or Mitchell Kelsey. We're joined by my colleague here in the Dubai office, Jonathan Bonnet, mate. G'day, how are you?
Good, thanks, Brett. How are you going?
Good, thanks, mate. So just for the folks out there who are maybe new to the episode or new to the podcast, I'm the Managing Director for the Europe, Middle East and Africa region for Atlas. We look after virtually from Mumbai through to London, now to Cape Town. And Jonathan works with us here as one of our senior financial planners on the ground here, providing advice to this region, mate. So look, today we want to run through considerations for retiring overseas, both for Australian expats and also too for Australian residents looking to make that move overseas in the later years of their life. And before we go any further, let's just get that disclaimer out of the way. All information that you are going to hear, see, listen to today should be construed as informational or educational purposes only. Please do not construe this as personal advice. If you do need personal advice, please reach out to someone like ourselves. So, mate, let's get the show on the road. So, I guess we've got two different paths here. We've got those in Australia who've spent their whole working life in Australia and are looking to see out their golden years in a foreign country. And then also we've got those existing Australian expats who are already overseas but not looking to go back to Australia in that short term. So let's go for option one first, and then we can touch on option two later. So for an Australian resident, spent 30, 40 years working in Oz, they are looking to go to Thailand, Malaysia, anywhere in Europe. What are some of the first high-level key considerations they need to consider?
Yeah, it's interesting. Well, firstly, we're beginning to see a lot more of these people. As a potential client group, we're seeing a lot more people over the age of 60 looking to move overseas, at least temporarily and sometimes permanently, although you never really know.
You never do.
So, no, you don't. But there's actually, the real issue is there's a fair bit of complexity around the different types of visas that people can access. And of course, every country has got its own nuances. The European countries are fairly consistent now, but basically, if you want to be somewhere for more than 6 months as a general rule, you're going to need some sort of long stay or semi-permanent visa, which will require disclosures around how much money you've got and, you have the capacity to support yourself and those types of issues. So obviously understanding the types of visas that are open to you and for the country you're going to is critical. Making sure that you let the right authorities know in Australia that you're going to be overseas, so especially if you get a part age pension and those types of benefits, if you want to continue to receive them, you better be sure that they, whatever
You're on the same page.
Yeah, whatever Centrelink's called now, I'm not sure.
Changes the name all the time.
Yeah, that's right. But they actually know about it and basically will tell you what they require from you in order to continue to get paid. So to be honest, they're the key considerations. But a lot of places, and if you've got like a side gig or you're a consultant or something, you need to also be careful that you get the right type of visa, because if you earn money in another country, even if you're not earning money from within that country, they may still regard you as a tax resident of that country, especially if you're there for more than 6 months.
That's right.
For example,
so there's quite a big difference between all the different countries, isn't there? You got the Thai retirement visa where they won't tax you on anything outside of Thailand that is earned, as long as you can show and deposit the appropriate amount in a Thai bank account. They're happy with that. But then, like we're talking before, Italy, how many different versions are there?
I think there's 9 different versions of their long stay temporary residence visa, and that gets that typically has people staying in Italy for up to 2 years. But there's 9 different versions. Some of them for people that are working, some of them for people that are retired, and obviously the terms and conditions are different depending on who you are.
Yeah, and I think that's the biggest thing that people, they look at the brochure, they fall in love with it in terms of joining the dots, and that's obviously why people engage us. Join the dots of what are the implications of making that move? How is it physically and structurally possible? Because as well as first thing is getting the visa, you need a right of abode, because the last thing you want to be doing is going overseas for 5 or 10 years and then having to hop countries every 6 months. because I know I wouldn't want to be doing that in my retirement time. I'd love to sort of settle down somewhere and relax. I know the other consideration we always talk about with clients too is, how's that move going to affect your existing assets? And, probably the first one that comes to mind, which is probably one of the biggest assets for those looking to retire, is super. And, with the popularity of self-managed super funds, we're not seeing a lot of education on that side of it as to the ramifications of moving overseas for greater than 2 years. So you're exceeding the temporary absence rule. And, how do you manage those assets? So, to me, that's another key issue as well. And that goes hand in hand with the visa, because the last thing you want to be doing is accruing all this money and then paying excess tax, or if your self-managed super fund is deemed non-compliant, potentially losing up to half the balance. And then if you ignore it, it goes up to 90%. So it can be a very expensive exercise, and you'll certainly come back to Australia with your tail between your teeth, tail between your legs.
Yeah, absolutely. And a lot of the advisors that don't understand, especially around the superannuation issues, or the self-managed superannuation issues specifically, really do have a she'll be right attitude. And really, it's not adequate. You really must know these issues. You must know the rules, and you've got to make adequate provisions to either change the nature of your fund, get a professional trustee, whatever you have to do, you need to do that if you're going to make yourself semi-permanent resident overseas.
Quite a lot of accountants will say, just appoint your brother, sister, siblings, children, as a director of a corporate trustee, and as you say, she'll be right. But as ASIC says over and over again, that's rubber stamping. That's not actually changing the structure and what they want to see.
It doesn't pass that control smell test, does it?
No, because you'll still be overseas. You'll still be overseas pulling the strings at the end of the day, and breach of central management and control. But also, too, ASIC want to see the trustee have a beneficial ownership as a beneficiary, and if they've got 0 or 5% or 10% of the balance, they're going to say, come on, you're still the boss here. Whereas if we see a balance of greater than 50%, then that's a different story. But, that's just a real sort of high level stuff. We could do a whole episode on SMSFs overseas.
We could actually.
But quite easy.
But super's interesting in itself, because I think there's big opportunities for people that want to do this, to continue to use their super funds as their main retirement methodology. They don't have to take the money out of super and stick it in a bank account in order to actually move overseas for a couple of years, as long as it's not an SMSF fund. But yes, I mean, because the beauty of super over 60s, of course, it's tax-free.
That's right.
Capital gains tax-free, income tax-free, and there's opportunities around structure and strategy, more so strategy, especially if you're going to somewhere like France or Spain, that will tax, if you're there for more than 183 days, will tax you on worldwide earnings. But if you don't draw down, if you actually put a lump sum into your French bank account when you get there, you're probably not going to have to pay tax on that.
Yeah, and that's that divide between, do you convert an accumulation account into a pension account or what? So, and I think the hardest thing with a lot of folks is they'll seek advice locally being Australia, and not understanding the 5 stages that they're going to go through over the next 10, 20, 30 years, because quite often what we find too is when people move overseas, it's never forever. They might go overseas at 60, 65, 55, but then they'll tend to head back to Australia around the 70, 75 mark when they want to gain access to Australian healthcare services, Medicare, and all those sort of key considerations. So you can't just put a strategy in place that is step 1 without considering steps 2, 3, and 4.
Yeah, and I had clients in Australia that moved back from south of France, and they're Russian. They were in their sort of late 80s, I think. They're pretty old. Not offending anybody in their late 80s.
It's all relative at the end of the day.
It all's relative. But they're pretty old, but they went back because there was great grandkids.
Yeah.
And they loved their life in France. In fact, they missed their life in France. But the pool of family was bigger than the ideal living environment in south of France. their circumstance, they kept their super the whole way through.
Yep.
And so there was no real change. They were always using superannuation as their funding mechanism for their lifestyle in France.
France is an interesting one because we talk to 20 accountants to get 20 different interpretations of how super in a allocated pension mode should be treated. And I guess the hierarchy or the 40,000 foot statement is that the double taxation unit between France and Australia does not preclude any pensions from Australia, unfortunately. That'd be nice. That'd be nice to have that done. But then it comes down to how they're treating it. Are they treating it as income? Are they treating it gains, return of capital, or anything in between?
Well, they're clearly not treating it as return of capital. But when I raised that with a French accountant relatively recently, a couple of weeks ago, she said they probably don't know. And so there's possibly, in fact, we're going to write some letters, or we're going to have her write some letters to the French authorities questioning, whether the return of capital component in an allocated pension should be regarded as taxable or not. And they'll be interesting to see what comes out of that, because I imagine there's a lot of there is a lot of Australians in France that are living on superannuation pensions that are
three Facebook groups that I know of.
Yeah, that's right. And they all complain about this issue constantly. Yep. So we'll see if we can get an answer. If we do get an answer, by crikey, you'll hear about it. So.
No, we're good at that. And that's a good shout out to make sure you do follow our social media channels, which are in the show notes below, because anytime we find these little chestnuts of opportunity, we broadcast it out. We don't just keep it for our clients. We broadcast it out to everyone so everyone shares in the benefits.
And to be fair, Brett, the other opportunities, I haven't raised this. I'm going to raise this with a French accountant as well, who's the expert on expat dealing with cross-jurisdiction issues from a French perspective, is whether accounts should be actually roll back to accumulation and people simply do an annual drawdown.
Yeah.
And that might be more efficient. So, okay, you got a 15% tax rate inside your superannuation fund. But as we all know, that nobody pays a 15% rate with excess franking and the rest of it reducing the income tax inside the fund. So it might be better just to cop that pay that in accumulation and just do an annual drawdown.
Yep. No, I totally agree. And that's where I would say creative strategizing, but just creative planning. Thinking outside the box, because what we call tomatoes, they call tomatoes. So you can sit there and blast until you're blue in the face saying that, hey, no, this is a pension phase, but they don't care. It's their sandpit, and they'll do what they want to do at the end of the day. So let's move on to another topic too. I think that people need to consider, because we do see when you do get to that age, consideration for selling the family home and downsizing. And this too is another scenario that a lot of Australian residents wouldn't be aware of, because when you live in Australia, you live in your principal place of residence, you have the main residence exemption, you can sell that property tax-free. However, since 1 July 2020, that MRE, that main residence exemption, has now been removed for non-residents. So if you're living in your family home that you've raised all the kids in and decide to go to France or Portugal or Spain or Thailand, and then decide when you're over there, you know what, we'd rather take some capital out of it, or we'd like to buy a smaller place because we don't need it anymore, it's just the husband and the wife, then sometimes the worst thing you can do is sell that property, because what will actually happen as an overseas resident is you'll pay tax from the date of sale all the way back to the date of purchase. And if you bought a property in North Ryde for $400,000 in the 90s, that property's going to be worth a lot more now, and there'll be significant capital gains tax at the non-resident marginal tax rate too. So, I think that prior preparation is important before you go to make those decisions. If you are going to sell it before you go. If you aren't going to sell it before you go, then sell the kids, sell the dog, but don't sell it while you're overseas.
Yeah. And the other thing is, if you are in that situation, talk to us, because it might be far more beneficial for you to return home and live in it for 3 months and then sell it.
Yeah.
Because then at least we can apportion the time you've been away.
Yeah, no, you raise a good point.
As part of the capital gain, because that would massively reduce the total capital gains on that. In fact, I have a client doing that now.
Yeah, look, if you move back in that property, you resume residency, obviously passing the 183-day test, you are living in that property as a principal place of residence, then you can rejoin up the main residence exemption. And if it's within 6 years, that's fine. You'll get that whole period tax-free. If it's greater than 6 years, then there'll be a pro-rating of whatever that time frame is. Yeah, exactly.
It still won't be pretty, believe you me. It won't be pretty.
No.
But it's better than the entire amount.
It is. And then if you are, if you haven't gone into an allocated pension, you can look at concessional contributions if you meet some of the tests. But then also
downsizer.
I was about to say downsize is another one too. They've just reduced that age down to 55 now. So I know one client I'm talking to, they're looking at taking advantage of that age 55, downsizing before they go, and then flicking it and going across. So that's another strategy as well. And you hit the nail on the head. It comes back to the importance of seeking that advice before you go, because if you jump on that plane and all you're looking at is where you're moving to and the lifestyle you to live, it could be more expensive than you think.
Yes.
So
absolutely correct.
Let's jump on to topic 2 or option 2. You're an existing Australian expat, you're living overseas, you're not quite ready to move back to Australia yet, but you do want to have that that option left open to you. Similar situation to the Australian residents, but a little bit, you've probably got more assets sitting overseas. You want to know, where do you accumulate those? Where do you hold those? And, one of our catch cries is always, you want to accrue wealth in the country you intend to return to or retire to. Now, if you're 60 years old living in London, Dubai, Hong Kong, New York, Australia may not be on the cards just yet. No. But at some point in time, unless you've got complete conviction, Australia may be it. So in that preparation to that retirement phase, a repatriation of assets to Australia, using super, using IDPS accounts, non-taxable assets, those sort of things is another option as well too. A little bit more complicated than Australian resident. But the same thing, we always talk about, the world is full of change. And if there's one constant, it's our Australian citizenship and the high probability that Australia will be home at some point down the track. We always talk about intents or everything, instead of plans.
I read somewhere that Australians as expats are the group that is most likely to return home.
Yeah.
As a because if you see Brits in Asia, they're retiring to Australia or New Zealand or South Africa or wherever.
Yeah.
But Aussies will typically want to retire home for whatever reasons.
Exactly. Right.
So I totally agree. We're as a business, we're on the same page in the sense that we believe that people should maintain their super accounts and those sorts of things. Simply because super is actually a really efficient saving mechanism anyway. In many cases, vastly superior to some of the garbage that's sold as expat investments around the world.
In Asia and Middle East,
Oh, seriously, the 10-year savings bonds, they're seriously a disaster for most clients.
Exactly.
They're great for advisors selling them because they get outrageous commissions. The commissions are more than what super funds are allowed to charge.
Yep.
So, you're talking a complete paradigm shift in terms of cost. And the outcomes are really good too. Super accumulates it's not a zero environment. And I know the offshore bond, they say it's a zero environment, although the advisor commissions is the tax. But they're a great investment. They're a zero tax environment after 60. And you just need a tax file number to be able to open an account.
Yep.
So
which you can apply for overseas.
Which you can apply for overseas. So you just need a right to have a tax file number. You don't even need one.
Yeah.
I think they're an awesome opportunity. And people forget the non-taxable Australian assets, non-taxable Australian property pool. That's there really as a hangover from when I think it was the Rudd government thought that Australia should become a financial services centre for East Asia, trying to compete with Singapore and Hong Kong. So that basically means that listed assets and widely held unit trusts and all those types of assets are tax-free for the purposes of capital gains tax for non-residents. So that's us. That's all us Aussies living overseas. In the meantime, zero capital gains tax and just a 15% withholdings tax on your dividend, which is paid for typically by franking credits.
Exactly. So, and I think the other thing too,
there's no detriment,
No, there's not. And I think, to me, one of the hurdles that people who are overseas for a long time, expats who've been over for 10, 20 years accumulating their assets overseas, they come to us at the end and they go, okay, great, I've got all this money, I want to put it into super. They can't. We have to almost reverse engineer it, because you do have your annual contribution caps. There are things like the bring forward rule and those sort of things that we can use. But it really comes back to you almost need to be planning out 5 years at least from your retirement, just to make sure
10,
that, well, 10 ideally, but you think about it. I was thinking this the other day, what's the minimum time? It's 5, because you can do contributions in 1 year, no more in the next 2, and then obviously do it again. That'll take you out for 6 years worth of contributions in 4 years. And then there's obviously the rats and mice and stuff you have to take care of in the lead up to that last year. But then, and that's this is where I guess the confusion happens, and people just throw their hands in the air and go, oh, just too hard, I'll just pay the tax, which is just kryptonite to us, because it's so easily avoidable.
And it's there's two things. I was going to say it's willful ignorance, but it's not. It's not willful. Because nobody is willfully ignorant in a sense, especially when it comes to money. But people have got to get over their biases. A lot of Australians are obsessed with property, and to be brutally honest, investing in property back in Australia whilst you're a non-resident is not a tax-effective structure at all. But this alternative is monstrously tax-effective, more tax-effective than it is if you're in Australia. So if you like, the incentive to invest, whether it's property versus equities, when you're in Australia, property is the one that's got the incentive. When you're overseas, it's equities that's got the incentive. So, seriously, go where the strength is. You've got a free kick to accumulate wealth tax-free.
You hit the nail on the head, because just as you're talking about that, I thought of a couple of clients of mine who they bought property, with the intention of, assets for retirement and all these things. And the properties are all running at a negative cash flow because Australian property yields are incredibly low. So they were accruing, sort of anywhere between $10,000 and $30,000 a year in tax credits, which when they bought it off the person who convinced them to buy the property, said, look, it's great because you'll accrue tax credits and you return to Australia and you can use those tax credits to offset Australian income. The problem is these number of clients, when they return to Australia, they retired.
Any income.
They had no income. And they walked away from hundreds of thousands of dollars worth of tax credits that they'd accrued for many, many years. So coming back to your point about, property as an expat, especially going into retirement, it does demand a relook to see whether that is a core part. It doesn't map to your scenario going forward as a non-resident. Even if you go overseas as a tax resident, the biggest issue you're going to have is funding and all those sort of capital and cash flow items, which you don't want to have to worry about during retirement.
Yeah, it's funny. I had a client in previous life with DV&A in Queensland, and he was a IT guy, and he went to Singapore, and he did 8 years in Singapore. And he was a client before he left, and he's a client whilst he was overseas, and then he was a client when he came back. And so what we did with him was almost exactly that. So he sold his house and he sold his rental properties. We invested the money in IDPS
non-tax assets.
Yep. Loaded up super. We maintained contributions to super throughout. When he came back, we sold the investments and bought a house back.
Yeah. It's just demarcating your residency. We say it all the time, and I'll say it again because I think it's important that the message gets through. When you do leave Australia, you do need to take the curb off. You do need to take away your bias as an Australian resident, and the way you manage money has to be that of the country and the residence that you live in. So if you're moving to France, you have to act like a French person, because the tax rules, you almost tear up your Australian passport, total ignorance of where you were born or where your citizenship is. The tax rules, unless you're American or for someone from Eritrea, it's all about residency based. And that's the biggest thing we say to clients is, it's just not the same. When you go overseas, you need to really do that, because we do meet people on a daily and weekly basis who just, as you say, they'll take a she'll be right approach to managing your assets overseas, and they wonder why they're getting all these big tax bills, and suddenly they're in a worse opposition than when they left.
Yeah. It's potentially disastrous, and well, it's actually wasteful, because paying more tax than you need to is never a sound strategy.
No.
I don't know. I think it was Kerry Packer said. Remember, he said to the Senate, a Senate.
He said, no same person in mine would pay as much tax as yeah. He did.
Yeah. And he said, because you guys aren't very good at spending it. And
exactly.
That's so probably true for every government everywhere in the world. You know, unless you want to fund stupidity, then keep as much money as you can.
Exactly. So, mate, I think we'll wrap it up there. I think that's a pretty good analysis of the key considerations on the retirement aspects overseas. Bit of housekeeping for the folks. We're down below. We've got a link for any Q&A. If you have a question you'd like us to answer, either on this podcast or we also have the Expat Mortgage podcast with James and Jeremy. So please enter your questions there, and we'll look forward to raising them on the next episode. JB, mate, thank you very much for your time.
No worries.
And we'll look forward to seeing you around.
Cheers.
Thanks, mate. Take care.
Bye, everyone. Cheers.